And I want to welcome you to Steps to Investing by the Get Savvy webinar team of collaborators. As I mentioned before, if you just came in, we're going to be using the chat to get questions and to answer your questions and to share amazing resources and lots of links. So I would definitely suggest that you open up your chat. And I want to introduce myself. I am Kathy Fiedler from Illinois Extension. I am being joined with Alan. Alan, are you on? I know you're on, but you want to unmute and introduce yourself?
Sure. I'm Alan Sorcher. I am an assistant director with the Office of Investor Education and Advocacy at the United States Securities and Exchange Commission in Washington. I focus a lot and talk a lot about investor education and do a lot of talks like this, and much appreciate, Kathy, the opportunity to be here and looking forward to the presentation.
I'm so excited to have you here and so glad you're going to be here to help answer all the questions that I know that people are going to have. We also want to recognize our colleague Andrea Pellegrini from University of Illinois System, who had a lot to do with putting on this presentation but couldn't be with us today. So before we even get started, a couple things to take care of. One, this is an educational resource. We, the Get Savvy team, are educators. We are not investment advisors or brokers. We are providing this information as a service to you and others. But really, keep in mind, this is not investment advice. We're doing this to help you learn a little bit more about investing. I also really do want to take the time to acknowledge that collectively, the Get Savvy team represents organizations across the state of Illinois, which rests on the land of multiple Native nations. And we want to acknowledge them as we move forward with our work and today's presentation. And now we want to hear just a little bit from you and make sure you've got that chat function open. What state and/or county are you logging in from today? It looks like our numbers are growing as people are joining. So where are you? Okay, we've got Illinois all over the place, Missouri. Let's see where else is popping up here. Lots of different counties in Illinois. That's fantastic. Wisconsin, welcome. Just so much fun to see people from across the country and across the state having the opportunity to join us for today's conversation. So, and I love that everybody's getting their chat open. Fabulous. Hey, keep that coming. And I'm going to move on to talk about our learning objective. We've got a lot we want to do today. We'd like to give you an opportunity to sit back and think like, where am I in investing and where do I want to be in the future? We want to talk about the benefits and costs of different kinds of investment services. We really want to talk about the advantages of long-term investing and what that means, and then to think about how to incorporate all this information and the resources becoming kind of a way for you to plan where you want to take your next steps with investing. And I know that a lot of times people ask me, how do you know when you're ready to invest? And am I ready to invest? What would that look like if I was ready? And let's kind of have a little conversation about that before we get into other pieces. So really, we really do think that, investing, while it's something that we see as a place for everybody at some point in their life, there are some things that are good to have taken care of before you get to investing. And these are the kind of basic things. I don't think these are going to be a surprise to anybody, but it's just having your daily finances in order, feeling like you're in a healthy place, having insurance that protects you against risk, whether that's homeowners insurance or health insurance, renters insurance, having those things in place. And then, of course, having emergency savings. We need money that is liquid that we can have access to in case something comes up that we have to pay for it unexpectedly. And then after you have these sort of foundation of finances, then you're ready to think about different kinds of investments or possibly home ownership and getting started. So it sometimes feels like it takes a little while to get to that place, but it is important to have that financial security before you start looking at other opportunities with your money. And I just want to remind everybody that we have another webinar that we did not quite a year ago called Investing Basics. And Brooke just put the link to that recorded webinar in the chat. And it really goes over some, the basics, some of the things we're going to cover again today, but in a little bit different format. And it talks about having a financial plan and looking at where investment fits in there. So if you'd like to hear some more about that, or you haven't had a chance to hear that great webinar that my colleagues did, I would encourage you to go back after this and listen to that webinar as well. So I'd like to know a little bit more about the people that are on today, because it just kind of helps us in our conversations with you and as we're focusing our presentation. So I just launched a poll that is asking, where are you right now with stock ownership? And this is anonymous, so it's really just more for interest. And if you can give a click for the little bullet that's button that's most like you, it'll be kind of fun to see, where are y'all? And it's sliding around here. I'll give it about 2 more seconds, and then I'm going to let y'all see it. Looks like we have some experienced investors here. So hopefully you can see there, it looks like we've got about 40% of you have been investing for several years or longer, but then another 38% considering investing in stocks soon, but not having them now. So a really wonderful mix of people coming on today. So thank you very much. Okay. All right. So moving on, we got that information. We got our start going. So once you feel like you have that foundation and you're starting to think about investing, the first step in my mind is really to think about what are your goals and what's your timeline related to each goal. And understanding your financial goals is really quite important in that it can help you think about where do you want to be and what kind of money do you need to get there. And then understanding the time frame for it will let you really make some good decisions, informed decisions about which saving and investment tools are going to be best for you. For example, if you want to buy a car in a year or two, you're going to need your money somewhere relatively liquid, someplace where you can withdraw the money without having any financial penalties or losses. And in that kind of an example, a savings account is a real liquid, safe place to keep your money for those shorter term goals. But if in contrast, if you're saving for retirement and that's like 30 years down the line, then one of your primary concerns will be the effect of inflation on your money. And we're going to talk a lot about that kind of coming up here later in the presentation, but you might decide that investing in a diversified portfolio would be a way to help manage the effect of inflation. So knowing what your goal is and knowing the timeline is going to help you make your investment choices. Now, I think that we do have people coming on today from a lot of different financial scenarios or stages of life. And I realize that while we're going to be mostly talking about, long-term investing, many of you might not be ready or have the money to invest regularly for like putting away money each month towards long-term goals now. But maybe you're more interested in investing to learn about it. And sometimes I know it helps to actually do something to learn it. I'm this type of learner. And so you might be here today because you want to start investing in order to learn more about it. And it's great to learn more about investing. But we also just want to remind people to be aware that buying and selling stocks as an individual investor typically has a relatively high level of risk. And you want to be very careful because there's always a risk of losing your money. And so if you're investing to learn, remember to keep that amount that you're investing set as an amount that you could afford to lose if something didn't go well with your plans or with the market. And you can think of it as paying maybe as for a class, but a small amount. Just make sure you don't need that money for something else. And Brooke just put in a couple of different simulations you can try that don't involve real dollars. That might be another way to learn. Some beginning investors are using apps to become acquainted with investing. And remember also when investing, especially on an app that allows quick decision making, not to let this turn into a game when you're using real money, and to be aware of nudges that you might receive from the app that encourages you to make really fast decisions where you might actually end up losing more money than you even invested. So take care of your needs first. Make sure you're using money for the needs that you have before you start using it to invest, in the market. Okay, so with all those cautionary things, investing probably sounds really scary right now. And I'm not trying to discourage you from investing, because one of the things is we can't just put all our money into savings accounts or stick it under a mattress for long-term goals, because the money you have today won't have the same purchasing power for what you need later on. So prices for goods and services go up over time. It's called inflation, right? And if you've been listening to the news at all, it's all about inflation and what's happening in our economy. So in this example that you see in the slides, you can see how the price of a similar car, really a very similar car, right? Maybe the same one, went up over several different years. And that is because of inflation. So having enough money in your mattress to buy that Ford Mustang in 1996, it won't pay for it in 2021. And that's when we need to look at different options for those long-term goals that will help us pay for all kinds of our goods and services, including housing, food, and all those things in the future. Okay, so investing has a lot of risk and reward, and we're going to continue discussing those kinds of risks and rewards that you may encounter investing in the next few slides. And then as we're doing that, I want you to be thinking and applying this to yourself. How much money do you want to invest now or in the future? Where do you land on this? Because it's different for different people. And we also know, and there's research to back this up, that people face different barriers for starting investing and staying in the investment market. So historically in America, African Americans and Hispanic Latinos are less likely to be among investor households than other Americans, including Asian Americans. The gap for this is narrowing, but it still exists. And other factors like those that you can see in the table also can affect whether people invest. So you may face barriers too. Perhaps your extended family hasn't been inclined to invest or has had bad experiences. So this can, put up those kinds of barriers. But participating in this webinar and following up on the resources we provide is an excellent way to start knocking down those barriers. So I'm so glad that you are here. And I just want to also mention, sometimes in the media or writing, you'll see that people use the word savings and investing in similar ways. But here we're actually using them a little bit differently, as you can see as it's defined on this slide in terms of whether you have what the volatility and the risk of losing money. So we're focusing today mostly on investing, which has a range of low to very high risk of losing money, but also possible higher returns than savings. And I think this little design, image here is really nice because it kind of shows that when you have lower risk, like with cash, for example, in terms of volatility of losing that cash value right then, it has lower returns. But as you move into other investments like bonds or stocks, you're going to see that they have higher returns, but they also come with higher risk. So understanding yourself and your own risk tolerance is a piece of learning about where you fit with investing. And we've got a couple of different tools that in the chat that can help you assess your own risk tolerance. Okay, I am now going to pass this off to Alan to talk a little bit more about investing.
Okay, thanks, Kathy, and I'm hoping you can hear me. Perfect. Okay. So how and where do I end this? First, we're going to focus on how do investments work? If you could move the slides, Kathy. Okay, so this is very basic and very granular. Two ways that investments work, how you make money. One, your money earns money, and that is like putting money in a bank, and the bank, because it gets your money, pays you interest. The other way is something increases in value, or you hope that you would make an investment that increases in value. That would be typically like a stock. You buy shares of stock, and you hope that it increases in value, and you make a profit. So that's sort of if you were to look at almost any investment and peel it away, you'd find that it's very core, that you're basically either doing it one of two ways. Your money earns money, like interest, or you're buying something that you hope increases in value. Next slide. Okay, so we're going from the very granular to the very big picture. What are we looking at? Is that a Rorschach ink blot test? Is that stalactites or stalagmites? It's actually the large stock performance in the US from 1926, right before the great stock market crash of 1929 to 2019. Now, when we show this in presentations, there is usually one main reaction that people have. So I am going to ask you to put your reaction in the chat box. What's the most significant thing you see about stock market performance from 1926 to 2019? Okay, I see some of you putting it in, and I'm seeing more up than down, which is the reaction that we always get, and that's absolutely right. So when we look from a historical perspective, we see the stock market is up way more than it is down. And so what does that mean? That means that a long-term perspective on investing means you're going to catch those up years. And the down years can be significant, but over the long term, they get drowned out by all the up years. So the last big down period was 2008 to 2009, the great housing crash. I don't know how many of you remember that. You're probably too young. But I remember it, and it was scary. And it was scary because you can see on the chart there, the stock market went down almost 40%. So those people who were getting ready for retirement may have seen their portfolio drop by 40%, and that's scary. So the thing to remember is long-term investing is critical, but as you get closer to retirement, the short-term ups and downs in the market become more important, because you really want to be prepared as you go into retirement that you don't have a downturn that can affect your portfolio. Let's see, next slide, Kathy. Okay, so we just looked at the market from 1926 to 2019. What would that have meant if you were invested over that period of time? So we see here, if you had invested $100 in a 3-month treasury bill, and this is from 1928, but about the same period of time, your money would have been $2,084 after that time. Compare that to if you had put it into the S&P 500 stocks, including the reinvestment of dividends, and you would come out having over $760,000. Bonds would have put you at $54,000. Again, so that shows the value of long-term investing, and how stock performance, while though more risky than bonds and cash or treasuries, over the long term does quite better. And on average, the returns from stocks over the past 75 years or so is between 8 and 10%. Next slide, Kathy. Okay, so we just talked about all the ways you make money, but can your investments lose money? Yes, they can, and often they can do for some people. Your goal is to avoid your investments losing money. And how do investments lose money? Well, I put them into basically 2 buckets. Investments can lose money from ways that the company is operated. For instance, a company can be dealing with competitors that are just better than it is. Some companies may have a product that becomes useless. Think about cameras and Kodak and Polaroid. There are companies that aren't well managed. So companies can drop in value because of reasons to do with a company, or investments can simply go down because the market goes down. For those of you who've been following the last couple of days, look what the market has done. It dropped 1,000 points, up 1,000 points. So the market is all over the place, irrespective of how the performance of any one company. And because there are so many different ways that investments can go down, that's why investing in the market is risky. But we have to keep in mind the chart we just looked at. Over the long term, the market goes up. Next slide. So the question I always get is, okay, so you just showed me how the market works, but where do we go to invest money? Where can we open an account? This chart shows a number of ways you can do that. First way that I think most Americans do is through their employer retirement plan, typically called a 401k. That's where most people get the introduction to investing, and they get the opportunity to open an investment account in a 401k. Second way is through an IRA account, I know here in Illinois, you have the Illinois Secure Choice, which allows smaller employers to offer IRA accounts to employees. Another great way to invest. Outside of the retirement environment, you can open an account with a large mutual fund firm, a large investment management firm, through a broker-dealer, an investment advisor. There are broker-dealers that are discount and online. There are firms that operate what have been called robo-advisors, where you're getting more of a computer approach than an in-person one. So a number of different ways you can open an account and invest. Next slide. The first thing you really have to ask yourself in going through the process of where am I going to open an account or how am I going to open an account is really, you have to really ask yourself, what am I trying to do? What are my needs when it comes to investing? And so I've broken down sort of 4 questions you can ask yourself. One, do I need someone to make trades and occasionally, do I just need someone to make trades for me and occasionally give me advice? And you do your own research. That's probably a lot of people. Or are you someone who needs, every time you want to make a change, you want to talk to someone and get someone to help you with a recommendation? There are firms who actually can be more involved. They can give you ongoing investment management. But before they make a trade for you, they have to get your permission. And then probably a full service approach, which would probably be the most costly, is getting ongoing investment management, where you give the investment firm of the ability to make decisions for you. And they're in total charge. Because you're getting more, they're doing more, it's going to cost you more. Next slide. Okay, so here's what I think is one of the most important steps, no matter which road you go down as far as working with an investment professional or investment firm. And that is to check them out and check their background out. The key thing you need to make sure is that anyone who's helping you make investments or give you investment advice is licensed or registered at the national level as well as the state level. We have a tool on investor.gov, the SEC's website, that allows you to check any investment professional or any firm. In addition to finding out whether they're licensed or registered, you can check their employment history to make sure there are no unusual red marks or black marks on what they've done, and make sure they haven't been charged with any criminal actions or had any bankruptcies. But again, the most important thing is to make sure they're licensed or registered, because that's what the SEC and the rules and laws require. So for instance, if I were on this call, rather than to help you understand investing, but I was trying to actually have you come with my firm, what I'd want you to do is to put my name into our website tool and see if I was in there, because our rules require that I be licensed with the SEC, but also licensed here in Illinois. Next slide. Okay, so I want to come back to investing for retirement, because again, most Americans invest through their retirement account or an IRA account. It really is the easiest way. For those that are in their first job, or those that are soon to be going to their first job, it's one of the first things you should find out, hopefully during orientation or very early on. Does your company have a 401k? Why are those so significant? Well, it gives you automatic regular investing. Your investment is taken out of your paycheck each 2 weeks or every month, whichever way it works. There are federal tax advantages that it may reduce your federal tax each year, and some employers actually match. Where if you invest, they will match you up to 5%, and that's what really critical. In my office, we say if you're not putting in up to the match amount, you're leaving free money on the table because you're not getting the match from the employer. If your firm doesn't have a 401k, you should take advantage of an IRA or a Roth IRA, for really the same reasons. Next slide. And I think, Kathy, that's where I hand it back to you.
Yes, thank you so much, Alan. That's great. And just to add on that last slide, if you are in Illinois as a resident, then you can also look into the Illinois Secure Choice, which I think mentioned in an earlier slide. Okay, so many things to think about. So where do you focus? And we want to now talk about when you're investing, that there's a few important concepts to really keep in mind when you're planning for the long term. And of course, what we're all trying to do is maximize our gains, right? That's what we want to have happen when we're investing, but there are no guarantees. So we are not telling you that this will be a guaranteed win, but there are some strategies that we want you to be aware of that might help you maximize those potential gains. And one of those is really understanding about compounding returns. And this is like, remember we talked about before about inflation and the need to have a way to keep up with it so that you actually have enough purchasing power later in your life. Compounding returns really helps with that. So when you invest money, so for in this example on the slide, imagine that a 25-year-old made a one-time investment of $1,000 and then did not touch the account again, assuming a 7% annual interest rate, then because of compounding return, that account would grow to almost $15,000. And because what is happening is that $1,000 went in, but each year it earned a return or interest, and that also was deposited in the account. The next year, there's a little bit more money in there to earn interest and returns, and it keeps growing at this really nice slope. So think about this. It's really the power that allows people to gain wealth, is putting it in and letting it grow over time. And just as another example of that, let's take a look at whether there's somebody that invested $2,000 annually for 9 years. And the example is from ages 22 to 30 years old. And then they stopped. They didn't put any more money in. Now, we're not saying that's what you should do, but just for this example. So they have put in $18,000 of their income. The amount they would have at the age of 65 would be over $579,000, assuming the money earned 9% return. That's a lot of money. But the point here also is, look what happens if that person didn't get a chance to start putting away money until they were 31. But then they were consistent about putting it away for the next 35 years. So they had 70,000 of their money income invested. They would still have a lot of money at age 65, but not as much as if they had been able to start earlier. And this is because what we call the time value of money. Having that time for returns to compound over time is a big deal. Sometimes I think the easiest way to kind of really understand this is to play with the numbers yourself. And so the investor.gov website has a great calculator called the Compound Interest Calculator. And you can kind of put in your own numbers and play with it and see what would happen if you started investing at a certain point and how much would you have down the road. So a fun thing to experiment with. Another concept and strategy that we really want to mention is diversification in terms of helping maximize your gains over time. And really what this is kind of like the picture says, don't put all your eggs in the one basket, but even to put it over to stocks means don't invest just in one company or industry. That's not diversification. That's one company or industry. A lot of times, small investors who don't have, tons of money to invest will diversify by buying mutual funds, which is a group of a lot of different investments or different stocks, for example. And this can lessen the impact of any one investment not doing well. And it can also help reduce business risk and market risk. Those things where a company doesn't do well or the market doesn't do well. Having diversification gives us a piece of our portfolio that's likely to be doing better. And so when we look at that, for example, a diversified stock portfolio, as we said before, wouldn't have just one company, but it also wouldn't have just one sector or one type of company from a business sector. And so this example, which is only an example and not of saying how you should put your money, shows 5 different sectors. So that protects yourself a little bit if, for example, one of these sectors goes down. And kind of playing off of something Alan said earlier, think about it, like what if you had decided that you were only going to invest in companies that made typewriters, like say you were investing a few years ago. Obviously, only investing in typewriter companies isn't diversified. And now in hindsight, it really doesn't look like a good long-term investment, right? You can also get another kind of concept related to diversification is allocation across asset classes. And we've been talking about having cash, having bonds, having stocks, maybe investing in real estate or other things. Having an allocation across different asset classes helps you, again, protect your portfolio from large swings, because often if one type of asset is doing well, another asset class might not be doing as well, and it kind of minimizes that volatility. Right, I'm going to turn this back over to Alan now to talk a little bit about investment costs.
Thanks, Cassie. So this is actually one of my favorite topics, and about fees and costs, because it's an area that really has changed over the past 20, 30, and 40 years. 40 years ago, which unfortunately I can remember, there really wasn't a lot of discussion between investment professionals and clients about what the fees and costs were. Today, there's a lot more disclosure and discussion. You can see that in a number of commercials that you see on TV for large financial firms. So the bottom line is that all investment services do have costs, right? What's the reason? Well, they're trying to make a living too. So there's got to be some benefit in it for them. We have seen a lot of migration of lowering fees. Many firms actually no longer have commissions on stock trades. The fees for mutual funds has come down. So it's a much more competitive landscape as well. So just to give a little bit overview on what are the fees, I mentioned one, there are commissions for stock trades and some mutual fund purchases, but again, the trend has been down on that. And again, there are firms that don't have commissions, but they're making money in other ways that you may not be able to see. There are firms that if they're managing your money, as I talked about earlier, they may be charging you a percentage of the money that you've given them, 1% or a little bit less. Of course, if you if you have an account, there's usually an account maintenance or management fee on a yearly basis, and of course, they will charge you fees to wire your money someplace else, and there could be other fees or costs as well, because again, the firms are in it because they have to make a living as well. But again, the good news is that the fees have been coming down, the disclosure has gotten better. But the bottom line is that you should be aware of fees, you should know what you're paying, and you should always be asking what it's going to cost. Next slide. So we wanted to really focus on how even small differences in fees, fractional differences, can have a significant impact on your portfolio over time. So what this chart is showing is 3 investors, and we'll say they're mutual fund investors. The blue line investor, each investor had $100,000 invested over 20 years, all made the same return, 4%, which is a little less than what the average annual stock market return is, which I said is usually between 8 and 10, but we just said, let's go with a 4%. Everything being the same except for the fee they're charged. And so the blue investor was charged quarter percentage point, 0.25. The red investor was charged a half a percentage point, 0.50. And the green investor was charged the largest fee, 1% annual fee. And so after 20 years, what happens to their investment? They all started off with 100,000, everything being the same except for their fees. So we can see that the blue investor, who was charged the quarter percentage point, ends up with 210,000, compared to the green investor who had the 1% fee, ended up with 180,000, a $30,000 difference. And the red investor is in the middle. So what's the bottom line here? 3/4 of a percentage point, 0.75 difference between the blue investor and the green investor ended up being, after 20 years, $30,000 difference, right? So who would you rather be? The blue investor who has the additional 30,000 or the green investor? I think we all would prefer to be the $210,000 portfolio, to have that portfolio. And so the question you need to ask is, what am I being charged? Because in this case, if you had you asked that question, maybe the investment professional would have just kind of just poo-pooed your question and saying, well, it's just a fractional difference. Yeah, it was a fractional difference, but that fractional difference had a large impact on the portfolio over 20 years. And if you can sort of just picture in your mind carrying this out another 20 years, those three lines continue to diverge, and the differences get greater and greater. Kathy just talked about compound and compound interest. What's happening here is the opposite of compound. Is compounding eating away your portfolio, that what the fee does. Next slide. One way to help you get lower fees is to be aware of index funds. I'm hoping that that many of you have heard of index funds. They've been around for the past 15 or so years, maybe a little more, but have become very popular, and really popular for a couple of reasons. One of the main ones is that their fees are lower. And let me tell you, to sort of discuss why the fees are lower. So an index fund is a mutual fund that tracks an index, like the Standard & Poor's 500 index. Those are the 500 largest companies in the US. And all that index fund is doing is using a couple of individuals as the managers and some computers just to track or mimic the stocks in the S&P 500. They don't need to do any more research. They just basically follow the stocks and the performance of the stocks in the S&P index. So it doesn't cost them much to manage that fund. They have low fees, and of course they're diversified, and have done historically well. The reason that they do oftentimes better than actively managed funds, where there's a bevy of researchers and managers who are trying to beat the indexes and have a strategy, is because they have smaller staff and lower fees. If you're an actively managed fund with a large staff and researchers, it costs a lot to keep that team going. And so keep in mind, as you are starting to invest or continuing to invest or looking how your investments are doing, that index funds typically have lower fees than actively managed funds. Next slide. Another way to sort of get, if you're thinking about how do I get started, is through automated or automatic savings and investing. If you have a 401k, this is actually happening and you're doing it, you may not be aware of it. If you don't have a 401k, it's something you should think about. So what are we talking about? It's where you automatically have $75 or whatever the number you want taken out of your savings account and put into a savings or investment account. And you have it done automatically so that it happens before you can spend the money. So in this scenario, we have someone who's having $75 a month taken out of their savings account and investing it hopefully in a mutual fund account. And look what the compounding does to this, the continual $75 each month over time. After 5 years, the person has over $5,000. After 10 years, over 12. And after 20, over $36,000. So people often will say, well, but I don't have $75 per month. And while everyone's situation is different, if you break it down to, well, maybe that's just a coffee one coffee every week. Maybe it's taking my lunch instead of buying lunch. There are different strategies to get to that $75 per month that after 20 years could turn into over $36,000. Next slide. Okay, dollar cost averaging. I don't know if you've heard of that. And again, if you are doing an automatic savings like I just showed, or you're participating in a 401k, you actually are doing dollar cost averaging without knowing it. So what is dollar cost averaging? It's where you're investing the same amount of money over a period of time. We'll just take, let's just say a year. So if it's your 401k, you're having $100 taken out of your paycheck each month. Each month it automatically happens in January, it happens in February, it happens in March, and it happens every other month. Well, what's the dollar cost averaging? Well, your investments each month are being made at wherever the market is at. So if we know, for those of you who follow the markets have been very volatile this week. So you're making purchases when the market is down, when there are those volatile times and the market drops down. And unfortunately, but the reality is you're also making purchases when the market is hitting record highs. And because you're making purchases wherever the market is, because of your monthly buy, because you're 401k, you're dollar cost averaging. You're catching the market at wherever it is. And it's a great way to invest because it's automatic. You're making investments when the market drops and taking advantage of those dips. And a good thing to keep in mind. Next slide. Okay, strategies to minimize losses and maximize gains. I would gather that that's what we all want to do, right? We all want to minimize losses, maybe even make them go away and not have any, and maximize our gains. So how do we do that? That's really the secret for all of us. And I hope that what Kathy and I are talking about today can help you achieve that. So obviously, Kathy's talked about compound returns. That's how the market works. And compounding is critical. And the best compounding happens by being in the market, allowing you to take advantage of your time in the market. Diversification, as Kathy mentioned, is critical. And having a diversified portfolio will help you weather the ups and downs in particular sectors. As I mentioned, and I'm a very big believer in keeping your costs low. Remember I said, fees act the opposite of compounding. They eat away at your portfolio. Investing regularly, which you're obviously doing if you have a 401k, that's the dollar cost averaging. So you continue to invest even when the market goes low or bottoms out. Well, that it's a little depressing for us when the market goes down. Through dollar cost averaging, when the market goes down, you're buying cheap, so that's a good thing. And then the last point is what I got to about checking every investment professional. You have to remember that there are people out there who unfortunately are trying to scam people. And so you need to have your radar up for the red flags of fraud at all times. And basically, if someone makes a presentation to you or is trying to get you to invest in something that seems too good to be true, and the most obvious one to me is, I've got a guaranteed investment for you. It probably is, because there are no guaranteed investments. All investments involve risk. Otherwise, we'd all be wealthy. So keep that in mind as you go through your investment considerations. Next slide. Okay, so minimizing losses is really important, as we've said. There are some ways you can do that. Obviously, you can't minimize all losses because we don't know the way the market is going to react. But let's talk about some ways that you can minimize losses. Next slide. Okay, my advice is to stay away for some risky investment strategies. Again, we've looked at the long-term performance of the stock market and just being in the market and riding the wave of the market going up over time leads to successful investing. But some risky strategies can lead the opposite way. What we saw about a year ago with the GameStop and meme stock trading and where stocks were promoted over social media, we saw a lot of short-term trading. Investors who were looking to cash in real quick and trying to do that when the market is very volatile, going up 1,000, going down 2,000 can lead to very significant losses. Other things that can lead to losses that involves quite a bit of risk or investing with on margin, in other words, borrowing money, options, or short sells, where you're betting the market is going to go down. Some of the problems that occurred during the period of heightened investment in the social media stocks were that some people weren't able to get their trades through because brokerage firms may be able to limit some situations when the market gets so volatile. And you have to also remember that a lot of, there can be, and there was stock manipulation that was going on with a lot of the stocks that were promoted on social media. Next slide. Again, what we saw during that period was those who were sort of becoming day traders and were trying to take advantage of the ups and downs in the market and hoping that they could actually make a profit by being able to time the market. We actually several years ago had done a study with the Library of Congress where it looked at how individual traders did versus how the market overall did. And they drew some conclusions. One is that active trading generally results in underperforming the market. In other words, those investors out there who thought they could beat the market and time the market didn't. The studies showed that investors tend to show poor timing in reality. They follow trends and overreact to good and bad news. Usually, by the time I hear about a trend, it's too late. The stocks have run up and they get in too late. And what do they end up doing? They end up buying high and selling low, right? When as a good investor, what you're trying to do is buy low and sell high. The Library of Congress report also said that trying to pick individual stocks may leave you inadequately diversified. In other words, putting all your eggs in one basket. And other studies have shown that missing the best performing days at any time period can negatively impact your long-term returns. So what does that mean? Well, you think you can time the market, you pull your money out, the market jumps up one day, and because you're not in that one day, you actually may suffer your long-term investment because you missed one of the big up days in the market. Next slide. I think this is one of the most important things that I really can emphasize today, and it really gets to the mission of the SEC in my office, and that is protect yourself. You know, we at the SEC have a role to help and protect investors across the country, but we can't do without you, and you really actually have to play an important role in protecting yourself. Excuse me, and the most important thing you can do is ask questions. Every question is a good one, and you should make sure you ask questions to the point that you are satisfied. Yeah, the point in the middle, you have the right to understand. As a client, customer, not only do you have the right to understand, but you shouldn't invest until you do understand. And you shouldn't stop asking questions or doing research until you understand the risk of what the investment is. And as I mentioned earlier, not only the risk, but the fees. And the last point that I think is worth repeating, if it sounds too good to be true, it probably is. So it's guaranteed. I can double your money, maybe. Keep those radars up. The market goes up and down. There are no guarantees. And if there were some guaranteed investments, you know what? We'd all take advantage of them and we'd all be wealthy. But investment involves risk. Next slide. Okay, so evaluate and modify. I think this is actually a good time to sort of take a step back because the markets actually have been so volatile this week. If you're 55 or 65 and getting close to retirement, it's probably been a little bit scary. If you're 25, it's probably a good time to say, well, wait a minute, what does it mean about this volatility? So whatever your age, I think it's a good reminder, step back, look at your portfolio. Ask yourself, are my investments, do they fit with my current goals? My goals as someone who's older are gonna be different than someone who's 25. And my goals are much shorter term. And that leads to the second question. Does the time frame of my goals match my assets? And so if you're someone who is in their 60s, close to retirement, you know, the question for you is, are you heavily invested in stocks and does that match your goals? The converse of that is if you're 25 and you're heavily invested in bonds and you have 40 or 50 years to retirement, does that match your goals? And of course, the hard question is, does your portfolio match your risk tolerance? And risk tolerance, there is no calculator really for. It's a little bit of a gray area, and it's something you have to, so you do your own gut check. You know, what stops you from sleeping at night? Last two questions you ask yourself: is your asset allocation on target? Okay. Number one, you know, is it divided up in the buckets that Kathy showed that makes sense for someone in your age group, your years left to invest, and your goals? And I guess the last question to ask is, are you contributing enough? We saw the charts that show how much it takes to save long term. You can use our compound interest calculator, but are you putting in enough to save enough money for your retirement? I think it's you want to be able to say, I am putting in enough, but I can do a little bit more. And so these are sort of the time to sort of sit back and ask yourself these questions. And if some of the questions you come out you're not so sure about, then take action and get your portfolio back on track to meet what your goals and hopes are. Next slide. Okay, just to summarize, goals. Know what your financial goals are, and most importantly, the timeline. Okay, this is an important question, especially today. Understand how inflation can affect future purchasing power. Kathy showed up how inflation can affect buying a car. Some of you may know the Federal Reserve is going to be coming out with a statement on interest rates today. They may raise interest, and what's the reason they're raising interest rates? Because inflation has raised its ugly head and has been the highest it's been in 40 years and eating away at our purchasing power. So it is some things to keep in mind. You know, one practical thing is, well, you might say, how does that affect me? Well, if you're someone who's interested in buying a bond, bond rates will probably go up after the Fed raises interest rates. So you might want to think about how you time your purchases of fixed income investments if we're going into a period where the Fed is going to be raising interest rates. I said this before, number 3, and I can't emphasize the importance of it. Understand the risk of investments and how they can lead to losses. Never invest in something you don't understand. Take the time to understand it and really do some research and ask good questions. Invest for the long term. I talked about the period that we saw about a year ago in the pandemic when there was some risky behavior, short-term trading, social media stocks, investing on margin, options. Invest for the long term. Okay. Try not to get caught up in the trendy things. The papers report on them, and obviously there are people who might be making money on them, but there are also people who are losing money on them. Long-term investing has been shown to be the way to go. The key, of course, is diversification. I talked about low cost and regular investing. It's really important to set yourself with a sound plan of investing with a diversified portfolio. You want to be doing that during a period when the markets are sort of okay, and not doing that when the markets are in flux. And lastly, protect yourself from significant losses. And that's by having your radars up, being aware of the red flags, not being caught up in the trendy trends that are going on, and just follow a good basic diversified investment plan. Next slide. My office and the SEC, I hope, has some good tools to help you. We have lots of brochures. We have the compound interest calculator that Kathy showed. You can download anything on our website. Pretty much there's everything there is focused on questions that individual investors may have. So if you have questions about mutual funds or ETFs, hopefully the answers are there. And we also have an 800 number if there's something is not there that you have a question about. So with that, Kathy, I'll turn it back to you.
Thank you very much, Alan. That was fabulous. And we're coming to the end where we're going to be taking questions, and we hope you've got lots of questions for us. But before we switch to that, just a reminder that the Get Savvy team will be back in February 9th, to talk about money in relationships, about a whole shift in direction. It should be really fun and interesting. So if you haven't already registered, you can do that now and book with that link in. And now we really want to hear from you too and have questions. Having Alan on is a real treat, and he's excellent at answering questions, and I'll do the best I can. And with lots of partners on too. So what questions do you have for us? If you can put them in the chat, that would be great. And then don't forget to stay in touch with all of us. Lots of different ways you can stay in touch with us. We're all over social media, on the web, all those great places. So I'm going to be looking for questions here, and thank you for the positive feedback that I'm seeing. Alan, maybe you would want to, I don't know if you, don't mean to put you on the spot here, but there was a question about, a couple questions. How do you invest in index funds? Somebody else said, I'm a little confused about how to invest in index funds beyond an IRA or a retirement account. Would you like to touch base on that one?
Yeah, so good question. I'm glad people ask them. So index funds are bought the same way you'd buy a mutual fund. So you have to do it through a broker dealer, an investment advisor, a mutual fund company, and so you'd have to find, you know, one of the companies that you might see advertised on television or online, and either go in or open the account online. But if it's done in the non-retirement fund context, you know, that's very easy to do. Again, you could do it on some of it online. And so an index fund is a kind of mutual fund. So it's no different than buying a mutual fund. If you, the reason that you may not want to, that they're not so much offered in retirement accounts is, well, they are, but that you're doing it through your retirement account, but you may not be aware of it. Because the purchase is being made for you. So if you have a 401k, what you might be buying is an index fund, but you may not know that because you haven't seen that. It looked to focus on the name. So is that helpful?
Yeah, I think so. And then one thing that I know I've done before is just, you know, search the internet, use Google to say, you know, low cost mutual fund companies, and a lot of times there'll be different articles out there about that. It gives you an idea which company might overall tend to have lower costs, although you still want to ask questions too. Okay, if that didn't answer your question, put it back in the chat or be more, you know, give us a little bit more input to know which direction to go. Okay, here's a question that I honestly don't know the answer to. Maybe somebody else online, maybe Alan, you do. I've been hearing about an accredited investor. Could you talk about it? Do you know that term?
Yeah, so I can jump. So an accredited investor is an investor that meets certain standards. Certain is some high income standards. It generally has an income above $200,000, have assets not including residents of $1 million. And I'm not sure why the person asked it, but it's a good question. And the importance of it is, there are some investments that are limited to only people who qualify as accredited investors. And the one case that it comes up in most scenarios is that there are certain stock offerings that are considered private offerings. They're not made available to the general public. They're smaller, and they are not fully registered with the SEC. In other words, they don't have to file an initial registration statement and all the filings. They are, so because they don't have all the filings to protect investors, in order to invest in it, you have to be an accredited or a high net worth investor. And so the rules are there because there's not as much information to understand the investment, that it limits it to accredited or high net worth, with the theory being these investors have the ability, because of their high net worth, to do a little more digging and research on their own to invest in these non-public investments, and they're private securities offerings. Does that make sense?
Yeah, and I just learned something new, which is fabulous. I always say that every time I do a program, I learn something new. So Steve had a follow-up question like that. Could you give an example? But I don't know.
So, I mean, again, they're private investments. They're limited to the number of investors they can invest that they can get. So, you know, let's just take a company that goes public and files a registration and initial public offering. unlimited number of people can buy the stock once it goes online. These are private offerings that are not traded on a stock exchange. They're limited. I think it can't be more than 2,000 investors. It might be something that's related to in real estate. So somebody who's buying real estate in the in somewhere within Illinois puts together a investment based on the real estate they're buying, puts together a private offering statement, and then can only offer it to people who can qualify as accredited investors, again, because limited information about it, not traded on a stock exchange. And so if you're interested, you actually have to tell them and basically vouch that you meet the accredited investor standards. Again, the theory being that if you're someone who is just starting out, doesn't have a lot of money, this might be too risky for you.
Steve, I'm going to move on to a couple of other questions. We can come back if we have time at the end to dig into this a little bit more. And there's another question here that I think is real important from Karen. If you can't get into an electronic account and their help folks aren't helping, what recourse does one have? Alan, you want to? Can people
I'll take a stab at it. I'm not exactly sure what I mean, but I'll take a stab. So I guess if there are obviously investing apps today that again have been in the news, particularly over the past couple of years of the pandemic. There are most investment firms and brokerage firms actually do have apps themselves that you can access them. You can walk into their offices as well as access your account online. Some of the things about the investment apps that we've all seen and gotten popular is the low cost about them, and you actually don't have as much opportunity to go face to face with someone. And so I'm thinking this question gets to maybe someone has an account through an investment app, and they get stuck trying to accomplish what they want. So if that's the case, I'd say you have to obviously just use your good common sense and try to get through their IT or someone to get whatever your situation is. But the point that we make is that there are obviously investment apps out there. They're legitimate. They actually have to register with SEC. But one of the reasons that they may be low cost is you have less opportunity for face-to-face. And sometimes you may run into problems like perhaps this person is running into. I don't know if I've been helpful, but that's my thoughts.
Yeah, I think that's helpful. I think another thing too, if you're really not getting what you need from an investment company, contacting your state's attorney general's office is another option. And I've got somebody online looking that up right now for Illinois. So or contact us or as well. We have our number is up there. I wasn't taking it that was that serious of a problem, but Kathy, you're absolutely right. If it becomes a serious one, contact our 800 number as well, and our team will help to get the firm to respond to you. Yeah, sometimes it takes calling in the big dogs to get it to happen. So we have another question here. I work with undergraduates, and these are great questions, guys. I'm having fun with these. So I work with undergraduates, and they want to know where to go just to start with small sums outside of an employee retirement account. Do I recommend any of the apps that are out there? And I will just say that University of Illinois Extension and other collaborators here, we cannot recommend any particular apps. Some things are better for some people than for other people. I think doing your own research to compare those apps and finding out what fits people's needs best are important. All the things that we talked about in terms of cost, accessibility for health, those things are really important. So that's what I'm going to go with, unless anybody wants to add to that. It's always hard when I just tell people you got to go do your own research, but in the long run, I think it's better.
Yeah, and it doesn't have to be. It can be an app, or it can be a large firm that offers mutual funds as well.
Right, and so I do know that sometimes young people will also look at a Roth IRA or an IRA, which is just like a bucket that holds other investments. That's another place to get started, but they may take a little bit more upfront money. Okay, all right. What questions? We've got phone numbers there. If you have Illinois Attorney General's office, you have things you need to follow up with. Remember that we have been recording. This will be available up on the web. Give us a couple weeks to get it published and get an email out to you that has that link. Well, the link will also include a lot of information about all these resources that we've shared too. So watch for that. Thank you so much for joining us today. We've really appreciated all your engagement and interest, and have a wonderful day. So thank you.